Hey, hope you're all doing well out there. This is your January market review. The reason that I put these videos together each month for you is to get you the straightforward information with no media spin, political angle, or fear tactics that many media outlets use to get more viewers to watch their shows. My goal with this ultimately is to give you the information about what's going on in the stock market and the economy, and then how that affects your money. Stocks across the board for January started the year down. The S&P 500 was down about 5.5%, close to 6%. The NASDAQ and small cap stocks were down even further. NASDAQ was down the most dramatic just because of technology stocks really getting hammered. The big news that pushed stocks down this past month was that the Federal Reserve is deciding to likely raise interest rates to help combat high inflation. So inflation over the last 12 months was reported around 7%, which is extremely high versus what we have been used to here. And I'll talk more about that with just some charts and other things. But the reason that it is as high as it is right now is because of COVID and all the stimulus that the government put into the economy to help get it going again. And now inflation as a result of the economy being a little bit too hot. So GDP, which is a measurement of how well our economy is doing, that's basically the production that we're making as an overall economy, was 5.5% here over 2021, which is a very high number as well. So kind of to go right alongside of high inflation. So if the Federal Reserve does decide that they are going to raise interest rates, which is pretty likely, it's just really more so how many times are they going to do it, then that'll likely slow down the overall economy to a degree, but hopefully take inflation down along with it. So they're trying to, have this fine balancing act of not crimping the stock market, the economy, and all of that all at the same time with raising interest rates. So that's the big thing that's kind of driving some choppy markets here over the first month of the year so far. So a few charts that I have, first one kind of going right into the GDP numbers here to give you a good example of exactly how high 5.5% is. This chart here shows the year over year change in GDP, which again is just that measurement of output there. So for 2021, we were right at 5.5%. You can go back over time, see in 2020, obviously that was down a good amount because of COVID. In 2008, that was down because that was the last recession that we had before. That was down a pretty significant amount for that year. And you have to go all the way back through the early 1980s where we had an entire year where GDP was down. So being up 5.5%, you can see it hasn't happened since 1984. Like I said there, it's not a very common thing for GDP to be this high because our economy is such a large economy. For us to be growing at the rate that we just did over the last year isn't a normal thing. Typically, you can see from like 2010 through, really 2019, it was in that 2 to 2.5% range there, pushing 3% in some years. So, it's not typically, or at least it hasn't over the last decade, been extremely high. That's actually been one of the things that, you've heard politicians talk about, and government officials like the Federal Reserve, you hear them talking about kind of getting GDP on a higher growth trajectory. So if you go back into the 90s, even into the early mid 2000s there, higher than 3% was more of the norm. If not in the 90s, it was well above 4%, pushing 5%. So definitely, I thought that this was a very interesting chart to kind of show you and articulate what's going on in the stock market over the course of a month. Super short time frame. What's going on in the big picture is that as an economy, we're doing really, really well, which the stock market goes along with the economy. Remember that last year, for the year of 2021, stocks as a whole did in the mid 20% range as far as their rate of return goes. So the fact that the market at one point was down close to 10%, really not that big of a deal if we were to take into account all of what happened in 2021. So even still, as of me shooting this video here, February the 3rd, the market is still only about 6% away from its all-time high, which really is not that far from an all-time high. So We're just a little bit spoiled here recently with just stock market returns just ticking higher. Remember, the reason that stocks pay as much as they do and you make as much in stocks is because there's volatility with it. If there was no volatility at all, you wouldn't make any money within stocks. It'd be like sitting your money in a checking account or savings account. So next chart goes kind of right into what I was just talking about with choppy waters. So this is showing the timeline here going all the way back through 2010 and shows some different events that had gone on. So the most recent one was the stock market dropping almost 10% because the Federal Reserve decided, or is hinting that they're going to raise interest rates. Going backwards, there was the all-time high that the stock market hit right at rebounding from the March lows during COVID, which had happened just a few months prior. There's then March 18th, the Trump administration started talking about trade wars and that unsettled stocks. February of 2016, stocks sank roughly about 10% from their January highs as oil plunged. So I'll show you a chart here, oil, in another minute, but all of these are just major events. They made major headlines. They caused the market to drop off. But if we look at where the market was in 2016, and then we look at where it is today, so that index was at 2,000 at that point, and in the March lows of 2020, it had dropped to about 2,200. So we've more than doubled since the lows of March 2020, when we were in that in the middle of basically lockdown for COVID, and going all the way back through February of 2016, we've more than doubled since that point as well. So if stocks were to keep going on this same trajectory, in another 5 years from now, 6 years from now, your money would double again if you were fully invested in the S&P 500. So these are just things that happen along the way if you're an investor in stocks, as little short-term hiccups within major headlines that definitely move markets. But if you're a long-term investor, which if you're working with me, you are a long-term investor, then really just it is just another buying opportunity if you have money that's sitting in cash. So take it as that. If you're somebody that has money that's sitting in an IRA, that you may not be taking money from it, then this is an opportunity where it's not down really that much. It's kind of more just hold the course. But if you're somebody that wanted to be more aggressive 2 months ago, now would be a good time to talk to me about making your portfolio more aggressive if you'd like to be. So but I thought that this was just an interesting chart. It kind of shows some of those main headlines that have gone on over the last decade that have caused market drops, and inevitably we're going to continually get these over the next year, 5 years, 10 years. Like, there's always going to be some sort of event that happens that's going to cause stocks to drop off. That's just normal, and that's why stocks make as much as they do over time. So next chart I have is going into the crude oil prices. So kind of like what I was talking about there, one of the major events in 2016 was oil prices dropping. So you can see that there on that chart where oil prices dropped below $40 a barrel, which isn't good for energy companies. Think Chevron, Exxon, not good for them. Today, actually, this chart doesn't really show it, because I printed this out yesterday, but oil prices have gone above or hit $90 a barrel. So this is showing that's above $80, $85 a barrel. So we've gone from a really dramatic low point in the middle of COVID in March and April of 2020 to where we are right now, where oil is close to $90 a barrel. One of the reasons I bring this up, obviously, if you're paying attention to the gas prices that you're paying at the pump, this is directly reflective of that. Basically, gas prices will follow in lockstep what oil prices you're doing. So, as oil prices go up, that's not great for us at the pump, but as investors in energy companies, which all of your portfolios have some portion of the energy sector within it. So I've actually have for a large majority of you, it's actually an overweighted position where there's actually more stocks held within there, because energy I view as one of the better sectors throughout the rest of this year. It was the top performing sector last year, which is why it was a larger portion at least relatively speaking, of portfolios last year. I'm continuing that into this year because I think that oil prices and energy stocks will benefit from higher oil prices. So one of the reasons I brought that chart up. Another chart I have here, I have two more charts. So second to last one here I have is showing national home price change from 1 year earlier. So this is a lot of you have homes, so this is one of the reasons that I think that this is an interesting piece. Obviously, it doesn't tie it directly into the stock market, but kind of from a sentiment standpoint, it does, because the more your house is worth, the better you feel about your overall personal finances, the more you want to invest money, so on and so forth. So we actually hit about 19% year-over-year growth, and this is a national average, not just central Pennsylvania or Jersey or Maryland or Florida, wherever you may be throughout the country. That local area may be a little bit different, but it's going to roughly track right around what the national average does to a degree. So it spiked over 19%. You can see typically, over time, it actually is positive year over year outside of 2008, 2009. And then during the recession in 1990, it went a little bit lower at that point. So one of the common things that I'm hearing now from people, and this is another reason that I brought this chart up, is that people that are looking to buy houses, which if you already own a house, and I know most of you do, this probably doesn't pertain to you as much, but you may know somebody that it does pertain to. People that are looking to buy houses are waiting for this big drop to happen within the overall real estate market. And this chart shows outside of 2008, 2009, which was basically, that was the worst time to be holding a house or real estate, was 2008, 2009, because those values dropped so dramatically. But if we take that out of the picture historically, housing prices year over year are positive. So people think that all of a sudden they're going to go negative, like they're going to go down. More realistically, they're just not going to go up 19%. They're still likely to continue rising, just not at the same pace that they've been rising at. They may still rise at 4, 5, 6, 7%, whatever that number may be, which is far less than 19%, but that still means that those prices are going up though. So, keep that in mind for you out there that are looking to buy a house, or people that you may know that are looking to buy a house, that there's not a lot of times in history where all of a sudden real estate prices go negative year over year. The only one really, in the last 30 years is 2008, 2009. So something, food for thought for those people. Last chart I have is a little bit more of a fun chart. I thought I saw this a few weeks ago, and I thought this was kind of interesting, but not super surprising. So this is a chart showing U.S. retail sales at beer, wine, and liquor stores on a monthly basis, and showing this going all the way back through 2018, where it was at about $4.5 billion in monthly sales. And not surprisingly, all of a sudden when COVID happened, people want to start drinking more. So, those prices or those sales have continued to stay high, which just means that, here in America, we're drinking more. So I thought it was an interesting thing to see kind of the monthly drink rate that people are at. So, but those are the charts that I have for this month. If you want to link up to do a Zoom meeting, I'm very flexible this month. We can always do a Zoom meeting that way. Next in-person meetings I'm doing in central Pennsylvania will be in the second half of April, so a little bit out, but very flexible to do Zoom. If you have any questions, comments, concerns, don't hesitate to reach out to me. I'm more than happy to answer any of those. I came across one really good quote that I also thought was applicable to this past month. So the quote is, "The fear is the best fertilizer for future stock gains," meaning take the opportunity that fear in the stock market brings and add more money or increase your risk. So I thought that was an interesting quote. I didn't write down who it was from, but I'm taking credit for it now. So if you have friends, family members, coworkers that you think would be interested in having a conversation with me, please get them in touch with me. I'd be more than happy to have a conversation with them about their investments and help them with managing their money and getting it growing in the right direction. But if we don't connect here this coming month, I appreciate you taking the time to check me out. Until next time.